Welcome back to CFI, Credit Finance and Investing, and in today's video I wanted to touch base on a post that I saw on Instagram last night. So without further ado, let me bring that up. This is a post by Joe DeMarco, 629, talking about what to do if you're thinking about buying a house. And what was really impactful is, as part of our Treat Yourself Culture playlist, there are a lot of things that we do that may be little treats that impact our ability to buy assets or buy a house or buy something that would be in our financial best interest. So here's some of the items that he brought up. A $30,000 car loan will reduce your borrowing power by around $80,000 for driving a car. $10,000 personal loan will reduce your borrowing power by around $35,000. A $15,000 credit card limit will reduce your borrowing power by around $60,000. I'm going to take exception to this a little bit. A $15,000 credit card debt, actual money on your credit card, will usually be what impacts your borrowing power, not your credit limit. Now, I have seen some underwriters try to do that with a limit on a HELOC or some sort of an open credit line, but generally it's the credit card debt that actually reduces your borrowing power. And then he recommends to close these debts before you buy a home, and I would wholeheartedly agree. So let's look at some of the items that would affect your buying power. Fortune, the website fortune.com, talks about the average credit card debt in the United States being $5,733 per card holder. That's a lot of debt. Now remember, that's of course average. There's some people that are high and some people that are low. And they break it down further by age, and you can see that the age group of 40 to 49 has the highest credit card debt. Before that it ramps up, then after that it starts to get paid off, but that's a lot of debt for people to be carrying. Something that's even more scary is the amount people are paying for cars. And everyone knows car prices have gone up, but the average monthly car loan for the car payment in the United States for new vehicles is $738 and $532 for used cars. I was in the DMV the other day, last week actually, registering a car, and I asked them what percent of cars that come through in this DMV are financed, and they said 85%. That means 85% of people through that DMV that are registering their vehicles have a car loan that are somewhere in the probably $532 to $738 car loan range. I've seen a number of people who are renting properties whose rental payments on their cars are more than their rent. That's a lot of debt to have on a depreciating asset. So let's look actually at the home buying calculator. This is at FreddieMac.com, and you can see this is at myhome.FreddieMac.com. And Freddie Mac is one of the two government-sponsored agencies who do a lot of the funding of home loans. And what I really like about this calculator is how it allows us to play with the numbers and to come up with different details. So going in with just a basic number, if we have someone with a $65,000 income who has that low-end used car average car payment of $532 and no other credit card debt whatsoever, and a $10,000 down payment, let's say they've been able to save up $10,000, can they actually buy a home? Well, maybe. So the reason I came up with $10,000 is I looked at a home price of $300,000. There are 3% down payment programs out there, which would be $9,000, and that gives us a little bit of a cushion. So there's a method to my madness there. And an interest rate of 7%. Now, interest rates have been fluctuating up and down, above and below this level for a while. So if you're working with a loan officer, you can wait until the interest rates are where you want them to be and lock them once you're serious about buying a house and the rates have fluctuated where you want them to go. And you can see with these numbers, just on the face of it, it'll say you can afford a $158,000 home, which is not going to buy you much anywhere in the country. So how do we tweak this? Well, let's look at some of the other assumptions. So here we've got taxes and insurance. Now, property taxes, anyone who buys a house will pay property taxes, usually as part of their mortgage payment, but the governments want and when I say governments, I'm talking county and local governments, and state, of course, want their percentage of the property tax, and every homeowner pays property tax, and homeowners insurance. And this number here, the taxes, you're stuck with pretty much what you get. They assess your taxes based on your purchase price or based on what the average values are in the area, depending on your state. Homeowners insurance, though, this number can be variable if you shop around. And if you contact a homeowner or an insurance broker, you can find they can shop it around, or you can shop yourself by calling different companies, and you can get your insurance rates usually down a little bit depending on different factors that you're willing to accept. And then the other assumptions that we want to look at are your debt to income ratio. And the baseline that it came with in this calculator was 37%. However, if you have a good credit profile, if your credit is solid, if you haven't made any late payments, sometimes, and not very infrequently, this is something I've seen happen very often, this number can be pushed up. So let's just put a debt ratio of 45%. Let's match up the housing debt ratio at 45%. And what does this mean? Well, let's pull up a calculator real quick and I'll show you. If you make $60,000 a year, divide that by 12, that gives you $5,000 a month. What the debt ratio means is they would allow you to use a portion of that income as your debt ratio or your housing payment. And in this case, it's 0.45 or 45% times 0.45. That would give us $2,250 that's available for your mortgage payment if you have no other debt. If you do have other debt, that has to be subtracted from this amount. So let's go back up into the loan information. And you can see by just getting that debt ratio up, again, by shopping your loan around and finding out what the underwriters will allow, we're now up to a $209,000 house. Well, in major markets, that's not going to buy you much still. However, now the other thing we can do is pay off debt. And if we get rid of that $500 a month housing payment, we can now afford up to a $277,000 house. And if we work with buy downs or fluctuating interest rates and we get our interest rate down to 6.7%, we're now able to get into a $285,000 house. Again, in a metro market, that may not buy you a lot, but here's where things start to get interesting. If you shop around, you may be able to find homes. If you're willing to drive a little bit farther or live in neighborhoods that are farther out, you may be able to buy a house in even a bigger market like Seattle. So, something that I did is I pulled up the Seattle market on Trulia, and I wanted to see what was available. So I sorted price low to high. And if you're looking at Seattle, these houseboats you're not going to be able to buy. They won't finance them normally. And you'll see there's nothing really in the immediate area until you start to get outside Seattle. And you can get into SeaTac, and there's a 3-bedroom, 2-bath home that will need a bunch of work. I can almost guarantee it. But you can start seeing that now we're in the $375,000 level. Okay, well, we can only afford $285,000. So what do? Well, we may have to drive a little bit. Now in Seattle, they've got ferries that go back and forth. But if we wanted to keep in our budget, so let's go down to the $300,000 level, because again, we're at $285,000, and you can also negotiate on house prices, of course. You can see that outside Seattle, there are some homes that we may be able to afford. Now, there are some fixers. There's houses that are absolutely going to need some work, but there's some other houses in the Tacoma market. Again, you're going to see a lot of fixers in this price range, but there are homes that we could afford if we are willing to drive. And in Seattle, it's not uncommon to drive an hour and a half each way to work. If you take this to a different market like the Boise or a Colorado market that's more rural, outside of Denver, you could do this. Even California, you can find homes that are in the inland areas that would be able to be afforded. Now, as a starter home, this may not be the home you want to live in forever, but then you can get in and start building equity. You can start taking advantage of some of the tax benefits that are available when you own a house. And you can start building wealth with the equity, because yes, even though people will argue your home's not an asset, you are building equity. That does become an asset. And when you sell it, you can use that to upgrade into a nicer home. So this is just a quick video. I don't want to spend a lot of time on some of the other aspects, but you can see that the things that we do to treat ourselves, that we may put on a credit card thinking, well, it's only a little bit that we have to pay every month, or it's a car loan, it's not a big deal, I need a car. But that can directly impact your ability to buy a house. Thank you for being here. If this video has been helpful, please like it. If you like this kind of content, please feel free to subscribe and share this video with someone who may benefit from it. Thank you.